Value stocks, growth stocks, dividend stocks. Everyone's screaming at you to pick one, but nobody's explaining which one doesn't leave you broke. So you're sitting there with your $10,000 wondering, should I buy Tesla at a PE ratio of 85, collect 3% dividends like it's 1952, or bet on undervalued stocks that Warren Buffett would approve of if he wasn't too busy buying Coca-Cola? Here's the thing. Most investors pick the wrong strategy for their age and goals, which is why 32-year-olds are collecting dividend checks for $47 a quarter while their friends 10x'd on Nvidia. I've made this mistake, chased growth stocks at the top, panic sold, then watched them recover 200%. Picture this, 3 investors, same starting capital. One goes growth, one goes value, one goes dividends. 20 years later, who actually won? By the end of this video, you'll know exactly which strategy fits your situation and why the advice you're getting from finance Twitter is probably wrong for you. Let's start with why this is so confusing. Finance Twitter tells you to buy growth. Your dad tells you to buy dividend stocks. Warren Buffett tells you to buy value. And you're sitting there like, can someone just tell me what to buy? Here's what nobody explains. These aren't competing philosophies. They're different tools for different jobs. It's like asking, should I use a hammer, a screwdriver, or duct tape? Depends what you're fixing. But here's the problem. Most investors pick one strategy and stick with it forever, regardless of their age, goals, or market conditions. That's like wearing a winter coat in July because it kept you warm once. Let's break them down one by one. Growth stocks first. Growth stocks are companies that reinvest every penny back into getting bigger. No dividends, no cash payouts, just pure, we're going to the moon, or we're going to zero energy. Think Tesla, Nvidia, Amazon. These companies trade at sky-high valuations because investors are betting on the future, not the present. Tesla's PE ratio right now, 290. That means it would take 290 years of current profits to earn back what you paid. The S&P 500 average, 28. Tesla is trading at 10 times the market average. The upside? When they work, they work. Nvidia crashed 66% from its peak in November 2021 to October 2022. But if you held through the pain, it came roaring back and hit new all-time highs. The downside? That 66% crash. If you panic sold at the bottom, you locked in catastrophic losses. Now, value stocks. These are the boring, beaten-down companies trading for less than their worth. Value investors are like thrift store shoppers. They're looking for a $100 bill selling for $60. The company might be out of favor, the industry might be struggling, but the fundamentals are solid. Think banks during a recession. Energy stocks when oil crashes. Insurance companies that nobody's excited about. They trade at low PE ratios, maybe 8 to 12 times earnings, because Wall Street thinks they're boring or risky. Warren Buffett built his entire fortune on this. He bought Coca-Cola in 1988 when everyone thought soda was dying. He bought Apple in 2016 when everyone thought the iPhone had peaked. He was right both times. The upside? You're buying $1 for 60 cents. When the market realizes the company's worth more, the stock price catches up. Plus, they often pay dividends while you wait. The downside? Sometimes cheap stocks are cheap for a reason. The company might actually be dying, and it can take years for the market to recognize value. Finally, dividend stocks. These are companies that pay you cash just for owning them. Every quarter, they take a slice of their profits and send it to shareholders. It's like owning a rental property, except you don't have to fix toilets. The best dividend stocks are called dividend aristocrats. Companies in the S&P 500 that have increased their dividend every year for at least 25 consecutive years. Johnson & Johnson, Procter & Gamble, 3M, McDonald's. These are mature, stable, cash-printing machines. The upside? Passive income. VYM, a popular dividend ETF, currently yields about 2.3%. That means if you own $100,000 worth, you're getting about $2,300 per year deposited into your account. And if you reinvest those dividends, called DRIP, it compounds over time. The downside? Dividend stocks grow slower, and yields around 2 to 3% are normal for stable companies. If you see 8% or 10%, that's a red flag. The company might be in trouble. The big reveal. It's about your age. So which one's best? Here's the thing. It depends on your age. If you're in your 20s or 30s like Marcus, growth stocks are probably your best bet. Why? Time. You can ride out crashes. You don't need income now. And compound growth over 30 years is absolutely staggering. If you're in your 40s or 50s, a mix makes sense. Maybe 60% growth, 40% value and dividends. You want growth, but you're starting to think about stability. If you're approaching retirement or already retired, dividend stocks become critical. You need income, not just growth. Selling shares to pay bills means you're depleting your capital. But dividends? That's cash flow without touching your nest egg. Let's run the actual numbers. Real ETFs, real returns. 3 investors, $50,000 each, November 2006 to February 2026. That's 19 years. Investor A, growth, buys QQQ, the NASDAQ 100 ETF. High-growth tech stocks. After 19 years with dividends reinvested, $285,675. That's a 471% return. Sounds incredible, but there's no steady income. To spend money, you sell shares and pay capital gains taxes. Investor B, value, buys VTV, Vanguard's value ETF. Boring, undervalued companies. After 19 years, $371,630. Wait, what? Value actually beat growth over this period with a 643% return. Plus, it paid dividends along the way for some income. Investor C, dividends, buys VYM, Vanguard's high dividend yield ETF. After 19 years, $171,890 in portfolio value. That's a 244% return, way less than the others. But here's the kicker. They're now earning about $3,950 per year in passive dividend income. That's cash flow without selling a single share. So who won? Value made the most money. Growth came in second. Dividends made the least, but created the most freedom. Reality check. Past performance doesn't predict the future. Growth crushed it from 2010 to 2020. Value is having its moment now. That's why you own all 3. Here's your decision framework. Ask yourself 3 questions. 1. How old am I? Under 40? Tilt growth. Over 50? Tilt dividends. 2. Do I need income now? Yes? Dividends. No? Growth or value. 3. Can I stomach volatility? If seeing your portfolio drop 30% makes you panic sell, avoid growth stocks. Stick with stable dividend payers. And here's the rule I follow. Never go 100% into any single strategy. Even in your 20s, own some dividend stocks for stability. Even in retirement, own some growth for inflation protection. The goal isn't to pick the winner. The goal is to build a portfolio that lets you sleep at night and reach your financial goals. Here's what most investors get wrong. They pick a strategy based on what's working right now, not what fits their situation. From 2010 to 2020, everyone wanted growth stocks because tech was exploding. QQQ crushed it. Then 2022 hit. Growth crashed 32%, and those same people panic sold at the bottom. In 2008, everyone swore off stocks and bought bonds. Then they missed the entire recovery. The pattern? Chasing performance instead of building a plan. So here's my challenge to you. Open your brokerage app right now. Look at what you own. Ask yourself, did I buy this because it fits my age and goals? Or because some guy on Twitter said it would 10 times? If you can't explain why you own something in one sentence, you probably shouldn't own it. And if this helped you figure out your strategy, hit subscribe. I make videos like this every week to help you stop losing money and start building wealth without the BS. Drop a comment telling me, are you team growth, team value, or team dividend? I'll see you in the next one.